Hello and welcome to BQ Prime. Joining us today are Joseph Anantharaju and Venkatraman Narayanan of Happiest Minds. They are speaking to us a day after Happiest Minds declared its second quarter results, where the revenue rose 4% sequentially to about 406 crore, but the net profit was flat. A point to consider is the company has cut its revenue growth guidance to 12% in organic terms. And in organic terms will be everything that will become over and above that guidance. Earlier, the company had estimated to grow at 25% overall. Gentlemen, welcome to BQ Prime.
Good morning.
My first question is to you, Mr. Narayanan, regarding the guidance cut. We see that the guidance has been cut to 12% on organic terms. So can you just guide us through what are you expecting and what is the rationale behind this cut?
Sure. When we started the year, we gave two numbers on guidance. One was on the revenue growth, which was at 25%, and the second was on the EBITDA, which was between 22 to 24%. When we gave the 25% guidance on revenue numbers, we didn't make a distinction between how much of that would come from organic or inorganic, because we had a couple of good targets in the pipeline. And as you would have realized, we have also raised capital, both equity and a little bit of debt, to make sure that these transactions that we had in the pipeline go through. So that was the basis on which we had given the 25% number. If you had asked me how much of it is organic, how much of it is inorganic, a quick back of the envelope would have told me that 15 to 20% was organic, and 20% plus would have been inorganic. That's how the 25% number stacked. Mm-hmm. Now, compared to that number, the inorganic has not happened. Okay. We were in talk with companies. One, it's getting delayed. These things tend to be binary. Mm-hmm. It happens or doesn't happen. We are in active pursuit of a couple of targets and hopeful of closing them. Mm-hmm. While that, and whenever it happens, we decide to take a look at the organic part of the business and give ahead of time guidance confirmation to the markets. Mm-hmm. And that's how we came to this 12% number. So we've done 12.7% in constant currency for the first half year. And we are looking to do a similar kind of growth for the rest of the year as well, taking us on a year-over-year basis of 12%. So 12% of organic growth. And if you had to do some comparison, it would be within the 15 to 20 organic that we had done internally. Whatever inorganic growth that we do in the next 2 quarters will be in at this 12%.
Okay. But at the same time, you have maintained your EBITDA guidance at about 20 to 24%. What gives you the kind of confidence, and what are the margin levers in play to maintain such a guidance, sir?
Very, very pertinent to note that this is the 14th quarter where we are beating this 24% number, which is the higher end of the guidance. And also important to note that compared to many other industry participants, we have gone ahead, given the pay increases that we had promised, which was between 8 to 9% for a substantial part of the company, effective July 1st. We have onboarded the campus joiners, most of whom we have on board as we speak today. Mm-hmm. And the third is on variable pay. We have paid what we had committed, saying that what we would pay, we had committed, and we have paid that as well. Why I'm saying that is, it's despite this, or in spite of these three things, we continue to hold our EBITDA at 24.4% ahead of guidance. And why I bring this point up is, as you would have noticed, many of the other industry participants have taken divergent views on these things. Mm-hmm. Now, it is for exactly these kind of things that we want to do in terms of investing into the business, that we had always kept this 22 to 24% gap, and also maybe a couple of percentage points. What we did ahead of the 24% would come in handy to make sure that we are building on the solid foundation that's required to build $1 billion company.
Okay. Coming to you, Joseph, given the macroeconomic scenario in the US, given the revenue guidance cut that is here right now, and when Mr. Narayanan mentioned right now about the $1 billion target, do you think that target has shifted a bit further away given the pains that we are seeing right now?
No, I don't think so, because if you look at it from a medium to longer term perspective, I think the assumptions on which we have built the $1 billion goal still hold true. Companies have to embark on their digital transformation journey. They have to adopt digital technologies, and they have to interact and engage better with their customers, improving their customer experience. They need to continue automating using new technologies like AI. So all of these fundamentals still hold true. And I think what we are seeing is a confluence of geopolitical and macroeconomic uncertainty that is making customers be a little bit more deliberate and studied in their decision making, which is elongating sales cycle. So our belief is that the medium and the long term potential for the offerings and the studies that we have still hold true. So I don't see that number moving, and we are pretty confident that we will be able to reach $1 billion by 2031, if not a little earlier. Okay. So that's what I would say.
Okay. So you mentioned about the medium term and the long term. We know that in the near term, you expect the revenue to be on a lower side. How are your conversations with clients like? As we have seen from other IT companies who have declared their earnings so far, and I think the scenario is similar with you, there is a certain amount of delay when it comes to conversion of deals into revenue. What are you getting the feel from clients in the US and in Europe as far as deal making is concerned? By when can that discretionary spending, those snap returns, start coming in? And are you still going after discretionary deals? Are you still looking at more long-term deals now?
So, when I hear the term discretionary, I would really like to clarify that, what we are seeing with customers, that their digital journeys and their digital transformation budgets, they don't see it as being discretionary anymore. It's something that they need to, these initiatives that they need to implement to make sure that they extract cost savings, but more importantly, that they continue to remain abreast of competition or maybe get ahead of competition. And so it's a question of actually survival, and in some cases of differentiation. So I don't see it as being a discretionary spend. And having said that, I think for the next the upcoming budget cycle is going to be very crucial. I think the kind of approach that companies take to what your next year's budget is, we will get a better idea in the November-December timeframe, and that will dictate what Q4 and FY25, most of FY25 will look like. And again, we can't lump all customers into the same basket. We are seeing some customers who start off. Many customers are starting their engagement or their digital journeys with more of consulting and discovery exercises, and then they get into implementation. And what we've seen is that there are a few customers who finish the discovery or the consulting phase, and then they take a little bit of a break while they absorb the output of the discovery phase and work through the internal discussions, deliberations, and budgeting cycle before really implementing things. So I think there are customers in both things where some of them quickly get on to their implementation and others take a little longer. I'm hoping that you'll find more of them jumping earlier and quicker into the implementation phase.
So my final question to both of you actually now is about your headcount. We have also seen a lot of other companies seeing a decline in headcount. What are your hiring plans from that end for the rest of the fiscal? So you're giving the wage hikes, the salary hikes have come in. So what are your hiring plans for the rest of the fiscal? Are you onboarding freshers going for the next 6 months? Any of you can pick up the question.
Sure, I'll take a swag at it and then.
Yeah.
Oh, go ahead, Venkat.
No, we have added 237 people this quarter, and a substantial part of that comes from.
So there's no decline in headcount for you?
No decline in headcount, like I mentioned earlier. So we have a gross headcount at addition only, which is 238 to 237 in number, out of which a substantial part has come from the campus joiners, which is what I meant when I said earlier that we did honor our commitments. The second aspect to be kept in mind is our utilization ratios. Today it is running at about 76%, higher by a percentage compared to Q1, but it is lower by a couple of percentage points from where we would ideally like it to be. So when we're looking at the growth for Q3 and Q4, both these aspects will come into play. One is how quickly we can deploy these freshers into billable roles. Second is also how can we improve the overall utilization of the company. Freshers have gone through the first phase of training and they're entering the workforce. And so that's one reason why the utilization is low. So these two things, when do we get to deploy the freshers or the joiners from campus into billable projects? And also, how do we up utilization? Both of these factors will play a critical role in how we handle the headcount in the coming quarters. But that said, we have made a guidance of 12%, which means another 6% over for the next two quarters, which is a early CAGR, and that's what we are looking to achieve. And we will be adding as needed to for that purpose.
Okay. Clearly, speaking to you guys, it's very clear that the next 6 months are very crucial for you. And I think the approach is going to be very steadfast and steady as you go ahead. Thank you, gentlemen, for joining us and giving us your views on the quarter results and the way ahead. Thank you, viewers, for joining in. This is Tushar for BQ Prime.